Okay, now in part one we talked about and we learned how buyers actually make a market or force a market to fall downwards, and how sellers or selling actually forces a market to rise upward, and how that is counterintuitive because it doesn't seem logical at first glance, but then once we start looking at it a little bit deeper, that it makes perfect sense. It's common sense or just basic logic. And we didn't get into the in-depth ways of trying to how you would attempt to trade support and resistance, and we'll take a brief look at a little bit of that concept here now in part two. Um, let's begin by, we left off talking about this bar, and let's talk about this bar again. Now, have you ever heard the phrase, you should only buy above support and you should only sell above resistance? Now, if we were thinking of buying or entering a long trade, the market here, would that be a good idea or would that be a bad idea? Well, let's break it down. When we look at the close of this bar closed up around here. And now, before we would decide if we wanted to enter a long trade, we would have to establish, okay, where is our first level of support? Meaning that if we buy up in here, and if price should happen to pull back, where will additional buying come into play? Where are the buyers located that in case the market should start to fall, where would the buyers come in to start buying and push price back up? And so we would go down to the high of this bar here, because this bar is the first level of support. After this bar closes above these buyers who used to be sellers but are now buyers, okay, they are the ones in these three bars, they are the ones who are going to provide the additional buying support that's needed to maintain price above this level and to actually push it higher. And so once this bar closes here, these are short sellers here, and if price should back up to this level and anywhere within the range of these buyers, short sellers who are now buyers, that is the range of your support, meaning that they will support your buying position. And so until price should fall below the range of these buyers, then you are in good shape to have other traders who have already entered the market support your buying position. And we see on the very next bar that price came down, but it did not touch support. So support has held. In fact, buying pressure started to increase before price even made it down to this level. So if price stopped here instead of going down here to this first level of support, then why did it stop here? Why didn't it make it all the way down? See, because a market cycle between support and resistance. A market will continue up until it hits support, meaning a market will continue up until it meets a location where you have sellers, and a market will continue downward until it meets a location where it encounters buyers. And so, but we didn't make it down, and why is that? Well, when we look at this bar here, and we'll draw our line at the open of this bar, and we see that when price closed, it not only closed above this level of support, but it also closed above this level of support. And we can actually see that it closed above the high of this level of support. But when we look at the range of the high, this is what's called the tail, and the rest of the bar, the red portion of the bar, is called the real body. And the real body is what's most important, is because this is within the real body is contained the cluster of sellers. And in the case of a up bar or a bullish bar, the real body is where the cluster of people who bought, but now they are sellers after they bought. But this contains the cluster. So in the tail you have a few, but in the real body or the main body you have the many. And when we're trying to anticipate where buying support will come in or selling support will come in, then we want to mainly focus on the real body. A stronger move will stop at the tail, but for the most part, most moves will go as far as the edge of the real body. And we can see that price closed above the open of this real body here, and by virtue of this close above, instead of this area being the first area where buyers will come in or buying support, it is actually here, or the open of this bar, this bear bar here. Now, to get technical, the buying will start as soon as the bar moves back down in here, but the real buying, the massive buying, will start once we get into the real body. And so now we see that if we entered long in this bar up above here, then we have actually two levels of buying support that can protect our long position, because now we know that buying is going to come in here and buying is going to come in here. So if price does break down into here, which it did, we still have additional support here. So in other words, this up move, or this bar that signals a continued up move, and it signaled that continued up move by virtue of closing above the first level of what is actually buying support. And so now we would anticipate setting a target. Where do we want to place our target? Well, once we look above here, and this next bar, it actually closed above support once again. So now the open of this bar is still going to be our first level of support. But now on the way up, we need to consider, now where are the overhead sellers? Where are we likely to meet the first level of selling resistance? And when we look over here to this bar here, this is a very, very bearish bar with many short sellers here who are going to be looking to buy back to close out their position. So where are the sellers going to come in? And really, there are no sellers within here, all the way up here. So we would anticipate price continuing to move up at least to the real body, or the edge of the real body of this bear or this down bar, because there is no resistance in between here to stop it. Now the closest resistance we have would be this bar here where these are buyers, and when price gets here, okay, they're going to be looking to sell their position so that they can at least break even and not lose money on their trade. So when we are conservative, we're going to look at these are sellers, and so we will consider that the first level of resistance is going to be within the range of the real body of this bar here, and thus if we entered here, this is the first place we want to consider taking profit. If we take profit, if we set our profit target here, there is a very high probability that the market will at least reach this point. And it's also a very high probability that the market will reach near the top of this bar, because these are sellers trying to buy back to close out. But if we're going to be conservative, we'll go one bar over, because we're interested in the first place where sellers are likely to appear, and that's going to be the real body of this bar. And as we can see, that support did held because price bounced off of support and actually closed above support. And we can see that on the very next bar, price continued up, and it actually shot up and then bounced back down, and it bounced back down off of some type of a resistance, and we can't see it here. But now if price made it as high as here before bouncing down again, then how would we have a better idea that price would have gone no higher than here? Well, first of all, because this is the edge of the sellers, this is the edge of where the sellers are, and once we get past this bar, then we run out of steam, meaning that we've run out of sellers. And so typically the high of this bar would be where we would expect this up move to at least stall, if not bounce and reverse. And then also we need to look back here, and when we look back here and we look at this bar here, we can see that, okay, there's additional sellers here, and we can see that there's additional sellers here. So once we get up here, the sellers pretty much run out, and when we look over here, we can see that this is pretty much where the sellers run out, and then new buying would take over here. So until we got a close above these sellers here, remember they're buyers when they entered, but they're sellers now. So until we get a close above here, and since we have also sellers here and sellers here, until we got a close above these sellers here, we would not anticipate any further upward price move until that happened, at least not on this current swing. So now we've seen how buyers make the market go up and sellers make the market go down. We've seen why we should only enter a trade if we have support behind us, and in this particular section we focused on support for an up move, and where we would want to enter the market and where we would want to theoretically set our targets, and it's all based on common sense. And as you can see here on this chart, I have nothing but price action, no indicators, no moving averages, no volume, nothing. And those can be overlain later to confirm and tighten up your entry and exit and your profit targets, as opposed to especially moving averages, because they provide an additional level of support and resistance, but they are secondary to price action. And you can talk about wedge patterns, head and shoulders patterns, ranges, and all of those patterns, but the really only one true pattern is the pattern of overhead support and below resistance. Overhead resistance and support below. That is the true pattern that all of the other patterns you may have seen that they derive from. This is the one true pattern, support and resistance. And so we'll end this section for now, and I hope that it helps you better understand how to time your entry, or at least when not to enter the market, because if you don't have any support underneath your entry, then you have no business entering a long position. And in the next section we will talk more about the same things, but we'll look down. We'll look at some downswings or a down move and see how the situation operates exactly the same way, just in reverse. I'm Jerry. Bye for now, and thank you for trading the laws of charts and men.